Welcome back to the Crypto Intellect, your trusted source for the latest XRP news, crypto market insights, and institutional adoption updates. Today's story is one of the most talked about developments in the XRP community because a growing number of investors believe a massive institutional shift is happening behind the scenes. The headline grabbing attention everywhere is simple but powerful. BlackRock just leaked the $9 trillion secret. Now, before we dive in, let's be clear. This is not financial advice. This is an educational breakdown of documented developments, regulatory changes, institutional movements, and market signals that have many XRP supporters asking one important question. Why are some of the biggest financial players in the world suddenly operating in a way that appears to align with XRP's long-term vision? The answer may not be as simple as a single announcement or a viral social media post. Instead, it may be hidden within a series of regulatory milestones, market infrastructure upgrades, ETF developments, and institutional actions that are quietly reshaping the digital asset landscape before most retail investors fully understand what is happening. The first thing we need to understand is that the XRP story in 2026 looks completely different from the XRP story investors were following just a few years ago. For years, XRP's biggest obstacle was uncertainty. Large institutions generally avoid assets that exist inside legal gray areas because compliance departments simply do not like unknown risks. Even if executives love the technology, legal teams can stop adoption before it ever begins. That is why the closing stages of Ripple's legal battle became such a major turning point. The conclusion of the case removed a cloud that had followed XRP for years. However, many analysts now argue that the real game changer was not the lawsuit itself. Instead, they point to the broader regulatory framework that emerged afterward. Once regulators began providing clearer guidance about digital assets, institutions suddenly had something they had lacked for years: certainty. And when certainty arrives, capital often follows. That is the foundation of the discussion surrounding the so-called $9 trillion secret. Many investors immediately connect the number $9 trillion with BlackRock because BlackRock remains one of the largest asset managers on Earth. When a firm of that size changes strategy, even slightly, global markets pay attention. The reason people are discussing BlackRock in connection with XRP is not because of one dramatic announcement. Instead, it is because many observers believe the company's broader push into tokenization, digital assets, blockchain infrastructure, and regulated crypto investment products indirectly validates much of what Ripple has been building toward for years. Whether someone is bullish on XRP or skeptical of it, one thing is difficult to ignore. Traditional finance is no longer treating blockchain technology as an experiment. Major financial institutions are increasingly treating it as future infrastructure. That shift alone has changed the conversation from whether blockchain will be used by institutions to which blockchain networks will ultimately handle institutional activity at scale. What makes this discussion even more fascinating is the distinction between owning digital assets and utilizing blockchain infrastructure. Many people assume these are the same thing, but they are actually very different. A bank does not necessarily need to hold large amounts of cryptocurrency to benefit from blockchain-based settlement systems. Likewise, an asset manager can support tokenized finance without publicly endorsing a specific token. This is where XRP supporters believe the market may be missing the bigger picture. Ripple's long-term strategy has focused heavily on payments, liquidity, settlement, and financial infrastructure rather than consumer speculation. As institutions increasingly explore tokenized assets, cross-border transactions, digital securities, and blockchain settlement systems, investors naturally begin asking whether networks optimized for speed and efficiency could play a larger role in the future financial system than many currently expect. One of the biggest developments helping fuel this discussion is the regulatory clarity that emerged around XRP. When regulators establish a clear classification framework, institutions suddenly gain a roadmap for participation. Compliance officers know how to evaluate risk. Exchanges know how to structure products. Asset managers know how to approach custody and investment offerings. The importance of that clarity cannot be overstated. For years, uncertainty acted like a wall separating XRP from major institutional participation. Once that wall began coming down, the market started seeing actions instead of speculation. ETF activity increased. Futures discussions expanded. Custody solutions improved. Market infrastructure evolved. These are not necessarily headline-grabbing moments on their own, but collectively they create an environment where institutional adoption becomes significantly easier than it was in previous years. Another reason the XRP community is paying such close attention to institutional developments is because of how rapidly the broader tokenization movement has accelerated. Tokenization refers to placing real-world assets onto blockchain networks. This could include stocks, bonds, funds, real estate, and countless other financial instruments. Many of the world's largest financial firms are actively exploring this area because tokenized assets can potentially improve efficiency, reduce settlement times, and lower operational costs. Suddenly, conversations that once sounded futuristic are becoming mainstream boardroom discussions. If trillions of dollars in assets eventually move onto blockchain-based infrastructure, the networks supporting those transactions could become incredibly important. That possibility is exactly why XRP supporters continue monitoring institutional activity so closely. They believe the future value proposition extends far beyond simple retail trading. At the same time, critics often argue that Ripple and XRP are too closely connected. This debate has existed for years and continues to surface whenever institutional adoption becomes a topic. However, one of the most important distinctions investors must understand is the difference between Ripple as a company and XRP as a digital asset. Ripple develops financial technology solutions. XRP exists as the native asset of a public blockchain network. While the two are connected through history and utility, they are not identical. This distinction becomes particularly important whenever discussions about decentralization emerge. Critics frequently claim Ripple controls everything, while supporters point to validator structures and public network participation to argue otherwise. Understanding the difference between the company and the asset is essential for anyone trying to evaluate XRP objectively. The validator conversation has become increasingly important because misinformation often spreads faster than facts. Some commentators continue suggesting that Ripple directly controls the XRP ledger, but the available network data tells a more complicated story. Consensus on the XRP ledger requires participation from independent validators rather than approval from a single company. Supporters argue that this structure demonstrates a level of decentralization that many critics overlook. Regardless of where someone stands on the debate, the important point is that these discussions should be based on verifiable network information rather than assumptions. Institutional investors especially tend to focus on measurable data instead of emotional narratives. That is one reason many professional analysts spend more time reviewing infrastructure and governance than reading social media arguments. The institutional adoption story becomes even more compelling when we examine real-world payment activity. For years, XRP supporters argued that utility would eventually matter more than hype. While speculative trading remains a major part of the crypto market, actual transaction volume and business usage continue attracting attention. Ripple's partnerships and payment-related initiatives have provided examples of blockchain technology being used for practical financial purposes. This matters because institutional investors often care less about internet narratives and more about demonstrated functionality. If a technology can solve a real problem more efficiently than existing systems, large organizations are far more likely to explore it. That practical perspective is one reason XRP continues appearing in conversations about cross-border settlement and liquidity solutions. Japan remains one of the most important examples of this trend. The relationship between Ripple and major Japanese financial entities has been developing for years. Rather than simply discussing future possibilities, Japan has produced measurable examples of blockchain-based payment activity. The growth in transaction volumes, remittance corridors, and financial integration has drawn attention from analysts around the world. Investors frequently focus on announcements, but actual usage statistics often tell a more meaningful story. When billions of dollars move through systems connected to blockchain technology, observers naturally begin asking what that could look like at a much larger scale. That question becomes even more significant when institutions around the world are simultaneously exploring digital asset infrastructure. Meanwhile, the conversation surrounding Bitcoin and XRP continues evolving. For years, the two assets were often discussed as direct competitors, but many experts now see them serving different purposes. Bitcoin is frequently viewed as a store of value asset. XRP supporters often emphasize settlement efficiency, transaction speed, and liquidity utility. These are fundamentally different value propositions. As institutions enter the digital asset space, they may evaluate assets according to entirely different criteria than retail investors. Some institutions may prioritize scarcity and long-term holding characteristics. Others may focus on transaction infrastructure and operational efficiency. Understanding these distinctions helps explain why institutional interest in blockchain technology does not necessarily translate into identical outcomes for every cryptocurrency. This brings us back to the BlackRock discussion. Why are so many people connecting BlackRock's broader digital asset strategy to XRP? The answer is largely tied to infrastructure. BlackRock's actions signal that traditional finance is becoming increasingly comfortable with blockchain-based systems. Whether through tokenized funds, digital asset investment products, or blockchain integration initiatives, these developments indicate growing institutional acceptance of technologies that were once considered experimental. XRP supporters argue that this trend indirectly strengthens the long-term case for networks designed to facilitate fast and efficient financial transactions. Even if BlackRock never explicitly promotes XRP, the broader institutional embrace of blockchain technology could still benefit ecosystems positioned to support financial infrastructure. The phrase, "the $9 trillion secret," resonates because it captures a larger idea. The secret may not be a hidden document or a leaked memo. Instead, it may be the realization that the world's largest financial organizations are quietly building for a blockchain-enabled future, while much of the public remains focused on short-term price movements. Institutional investors often think in terms of years and decades rather than days and weeks. They invest heavily in infrastructure before the broader market fully recognizes its significance. That pattern has repeated throughout financial history. Roads were built before commerce expanded. Internet infrastructure was developed before e-commerce exploded. Many XRP supporters believe blockchain infrastructure is following a similar path today. Of course, none of this guarantees a specific outcome for XRP's price. Markets are complex and countless variables influence performance. Regulatory changes, economic conditions, technological competition, investor sentiment, and adoption rates all play important roles. Responsible investors understand that bullish narratives and bearish narratives both deserve scrutiny. The goal is not to blindly accept every positive claim. Instead, it is to separate documented developments from speculation. When evaluating XRP, the most important factors often include regulatory progress, institutional participation, infrastructure growth, real-world usage, and broader adoption trends. Those are measurable indicators that can be tracked over time, rather than emotional predictions that change every week. What cannot be ignored is the dramatic difference between where XRP stood during the height of regulatory uncertainty and where it stands today. The conversation has shifted from survival to participation. Instead of asking whether XRP can remain relevant, many analysts are asking how large its role could become if blockchain-based finance continues expanding globally. That is a completely different discussion. Institutions are no longer watching from the sidelines. They are building products, launching initiatives, exploring tokenization, and preparing for digital asset integration. Whether XRP ultimately becomes a central beneficiary of those developments remains to be seen, but the environment surrounding digital assets is unquestionably evolving. As we wrap up today's report, the real question is not whether a single company leaked a secret. The bigger question is whether the world's largest financial institutions are collectively revealing where finance is headed next. Regulatory clarity is improving. Tokenization is accelerating. Institutional adoption is expanding. Blockchain infrastructure is becoming increasingly important, and XRP continues finding itself at the center of many of these conversations. That is why investors are paying attention. That is why analysts are debating the future. And that is why the phrase "BlackRock just leaked the $9 trillion secret" has captured so much interest across the crypto community. Let me know your thoughts in the comments. Do you believe regulatory clarity is the biggest catalyst for XRP, or do you think institutional adoption will ultimately matter more? If you enjoyed this breakdown, make sure you subscribe to the Crypto Intellect, stay informed, stay prepared, and I'll see you in the next one.